Good evening. You're watching News9 Live. I'm Shweta Kothari. The Capital Markets Regulator, Securities and Exchange Board of India, SEBI, has proposed a series of near-term measures to prevent speculative trading. Now, SEBI has been concerned about the volume of losses in the derivatives trade. In fact, SEBI Chief Madhabi Buch said that the households are losing about 60,000 crore rupees in F&O trading annually. Now, Indian markets have often flagged risks from retailers and participants in speculative trading in derivatives. In fact, SEBI's proposal are made in light of the increased retail participation and heightened speculative trading volumes in the index derivatives on expiry days specifically. 7 measures have been suggested by the market watchdog aimed at curbing market speculation, enhancing investor protection and ensuring greater stability. These include curbing multiple option contract expiries and increasing the size of options contracts, among others. Exchanges and brokers focused on retail traders are expected to be most affected by Securities and Exchange Board's proposed changes. What are these changes and what sort of impact are we expecting in the long and the short run? Let's talk about that. Joining us on the show is Rohit Srivastava, is the founder and Market Strategist, IndiaCharts.com. Also with us is Amit Gupta, founder FinTrekk Capital. With me is my colleague Suyash Maheshwari. Coming to you first, Suyash. Hi, good evening. Speculative trading has been one of the concerns of markets regulator now for a long time. It's been talking about it. I want to first begin by asking, why has it been a concern? And number two, what are these measures?
Certainly, Shweta, and you were just mentioning that for several months now we have heard both market regulator, the government and multiple parties raising voice about this unabated rise in retail participation, especially in the F&O market. And SEBI has released data wherein it says that about 90% of the traders dabbling, especially the retail traders dabbling in the futures and options market, are incurring losses. And finally, SEBI is now walking the talk. Now, in the consultation paper that was released yesterday, SEBI has proposed 7 changes to strengthen the entire framework of the F&O market, and this is for increased investor protection as well as market stability. I'll go through all these proposals one by one. First is strike price for options. Right now, Nifty and Bank Nifty options have up to 70 and 90 strike prices. This covers about 7 to 8% of the daily index movement. Now, SEBI wants to cut this down to about 50 strike prices at launch with intervals of about 4% instead of 7 to 8% and extending it to about 8% if need be. Now, this measure particularly can potentially reduce the overall market volatility. Second is upfront collections of options premium. So, currently, if you are an options buyer, you are not mandated to pay options premium upfront. SEBI has now proposed that buyers will need to, and I'm talking about options buyers here, will need to pay this premium right now moving forward, moving forward. Third is removal of calendar spread benefit on expiry day. So right now traders can benefit from lower margin requirements if they have 2 positions with different expiry dates. Now SEBI wants to remove this benefit for contracts expiring on the same day. Fourth is intraday monitoring of position limits. Currently, position limits are checked at the end of each trading session. Now, SEBI wants these limits to be monitored throughout the trading day with a phased plan for full implementation. Fifth, I think, is very important, which is minimum contract size. Now, the minimum contract size, and this goes back to 2015, was proposed to be about 5 to 10 lakh rupees. SEBI has proposed raising it to 15 to 20 lakhs initially, and after 6 months to 20 to 30 lakh rupees. Now, this means that contract sizes, Nifty, Bank Nifty, Fin Nifty for that matter, will go up by as much as 4%, and this could really squeeze out the retail investors, the small investors from the F&O market. And fifth again is minimum index minimum contract sizes actually. So weekly index products, as I mentioned, since we have different on derivatives contract, pretty much on all days we are witnessing expiry. For instance, a Bank Nifty expires on Wednesday, Nifty Financial Services contract expires on Thursday, Nifty on Thursday, Sensex on Friday, BankX on Monday. So pretty much on all days we have different expiries for different financial contracts. Now SEBI is proposing that that SEBI wants to limit this to one benchmark index per exchange this week. This means that exchanges will only be allowed to offer weekly options contract on one of their indexes. So NSE will have to pick one from Nifty Bank, Financial Services or Midcap. Similarly for Sensex, they'll have to choose between Sensex and BankX. And the seventh is margin near expiry. So no extra margin is currently required in the last 2 trading sessions before an expiry. SEBI wants to introduce an additional 3% extreme loss margin on the second last day of expiry and increase it to 5% on the final trading session of or the expiry day.
All right. Well, that, of course, sets the ball rolling on what these 7 measures are. Let me quickly get in our experts on the show. Rohit Srivastava, Amit Gupta. Rohit, coming to you first. Which of these 7 measures are most damning to you? Now, as my colleague mentioned, there have been conversations around some sort of tax on F&O in the run-up to the budget, during budget, but it does look like SEBI was waiting and SEBI has finally hammered down on speculative trading. Which of these 7 measures do you think is going to be most damning for retail participants?
So it's an interesting set of things, and you have to really put it in historical perspective. If you want to say that weekly options are bad, you would have banned. So let's say that we've accepted that weekly options are going to be allowed. But what do we do really to slow down retail participation? Now, I think changing contract sizes, some of them, in fact, most of these measures are going to do a bit in that direction. I don't think they are way off the mark because remember that Nifty options were, or in fact, all these options were introduced when Nifty was 1,000, right? More than almost 24 years ago. So that's a very, very long time. And over this time, Nifty has gone from 1,000 to 20,000, and you've still kept the contract sizes very, very same. I think they only increased it once from 2 lakhs to 4 lakhs. So why not go from 4 to 20 or something? That's what they're really trying to propose, right? That you increase it a couple of times. So that's a fair point because that would ensure that, somebody who's just bringing in 5,000 rupees or 10,000 rupees doesn't go out and speculate, which is the lowest rung of retail participation that you're really getting. So outright, you're not stopping people from participating. You're just saying that your ticket size should be a little bigger so that you understand the product. But the real risk in options is what? It's not the buyer. Remember, the buyer comes in with a premium. And in fact, it's already implemented by most brokers that you have to collect the entire margin, entire premium upfront. So I can't really go to my broker and buy options if my account doesn't have enough money for buying the premium. So the buyer has only that limited risk of premium, right? I've paid the premium, broker got the money, I can't lose more than the premium, and everybody knows it. So I don't think the buyer is a risk. The real risk is the seller, because, and we've seen this, many option books have actually blown up. Even when we were at Sherkhan, we've been through one of those episodes where the entire writing desk got, significantly hit when they were doing delta neutral strategies, and it wipes out margins when you get a significant one-way move in the market. Say, 2-3 days an event, there's a black swan event, and you get 3 days of downward moves or 3 days of upward moves, which are very, very sharp. Then the entire book can get wiped out. So it's the option seller, which I think is the biggest concern. And this is like big books that were getting wiped out. So today what you're seeing is retail investors have started to participate in option selling because they think it's easy money. You can, just sell something out of the money and you get the funds, as a writer. But writing is the big risk. And so increasing margins, which is essentially for option writing, does make sense. Increasing the contract size will also do away with, allowing small retail participants to sell options, which is the big risk of, it can wipe you out with M2M losses, mark-to-market losses in a big way. So that I think gets addressed by all of these measures. So I wouldn't say they're all bad. It's a good thing happening after a very, very long period of time. And here's another data metric, which I think most people don't know, is the shift away from, futures to options happened long time ago. During the last bull market, 2003 to 2008, the futures market was 85% of the total open interest in derivatives. Okay, and even then, I was at Sherkhan and we've looked at the data. Over years, people ended up losing money even in the futures market. So what that led to is that after the 2008, 2009 meltdown, people shifted away from futures to options. So right after the meltdown, the ratio shifted from 85% to 50%. By 2013, it had become 70% of the market options and 30% of the market was in futures. Now that ratio is 85% options and 15% futures. So people realize that they are losing too much money in futures. They can't handle the mark to market, and so they went for options where the risk. This is the premium. I won't lose more than that. So that's what has already happened. So now to say that, okay, people are losing money in options, it's by choice, at least on the buyer side. But like I said, the real risk is not the buyer. The real risk is the seller. And I think all these measures will attend to that. Sellers who are small will not be able to really participate. And that's a good thing.
Shweta, I think Rohit over here makes a really good point. The buyers are not at as much risk as the sellers are, because all a buyer can lose is the premium that they pay for, purchasing that option. Whereas potentially or theoretically for a seller, the loss is unlimited. And Amit, I think, is also with us. Amit, I'll ask you the same question. What do you think of the 7 proposals that SEBI has made could be, most concerning for an F&O trader? And which do you think is the best measure to finally put that plug on retail participation that has been rising, unabated pretty much in the last few years or ever since the pandemic?
Hi, Suresh. So I think all these measures will have a cumulative effect on the retail participations. Obviously, the rise in the contract size, upfront option premiums, all these things, would help in sort of curtailing the retail activities. There was sort of another proposal that they might come up with a suitability framework where they'll have a net worth kind of a criteria, or they'll have a educational criteria where they are going to make an exam compulsory to speculate in the F&O segments. I think those things are a little from a legal perspective, that's a little bit of a problem. How do you implement that in a country as big as India? So I think what they have done is they've stuck to the regulatory measures, what is in their control, what exchanges can actually implement easily. And they're hoping that, with these increases, the retail participations will get curbed. I was listening to Rohit earlier, and I think he makes a good point that, the bigger risk is in the option sellers and not so much in the buyers, because they're already collecting premium upfront. But for sellers, the risk is unlimited. Its upside risk is unlimited. As a result, that you need to curb that. I would also like to add that as the SEBI chief has also said, this has become a macro issue, and I think that has been there for past 9 to 12 months. Obviously, we were in a general election year, so these measures may not have taken place before. But if you go back in November 2023, when RBI increased weights on the unsecured lendings, one of the premises for that was there was a very good data points available, which told us that a lot of people are doing this unsecured lending, going on the various apps and taking a loan of 4 lakh, 3 lakh, 5 lakh rupees. And actually speculating that into the market, into the options markets on a daily basis. So I think that was the first step to tell that the situation has really got out of hand. And I'm glad that eventually we have come to this place today where there are enough curbs.
All right. Well, those, of course, are 7 measures. Let's also quickly go through some of these measures one by one. And we were discussing this, Suresh, right before the show. The fact that there's been a weekly reduction of options contract to 1 benchmark index per exchange, it's actually going to result in weekly contracts per month down to about 6 from 18. So from 18 to 6. I want to take this question to Rohit. Rohit, what sort of overall market impact and impact on trading activity are you expecting as a result of this reduction?
Yeah, so probably that's one measure which I wouldn't be too happy about. In fact, these are still suggestions, and I'm sure there will be pushback. The part that I like is, yes, you should have one date in a week, which is the weekly settlement. You can have multiple contracts on that day, so you could have all the contracts expiring on that single day. Having separate days for each contract, I think, was a big mess, and it has actually happened because of competition between BSE and NSE. And this is not the first time. For those, again, I can give you history for having been around here. NSE in competition with BSE when the Badla system was, completely BSE's game. NSE said, okay, we'll have a different settlement system. We'll start on Tuesday and end on Wednesday, whereas BSE was starting on Monday and Friday. The rub-off of that was that people who didn't want to pay margins were shifting positions without paying any margin from NSE to BSE and BSE to NSE, creating huge arbitrage opportunities. Now that led to excessive position buildup, and in the 2000 Y2K meltdown, it led to huge selling and losses. So these are the things that end up happening when you do silly things like this simply because you're in competition. So I think the competition between NSE and BSE has led to multiple days, different expiries, because BSE started with Sensex on Friday, then NSE put one on every other day. I mean, this is crazy. So having one day is perfect. But I think they should permit, multiple contracts. So
Okay.
that would then not harm the market that much. If they do away with all the contracts, you will definitely see a significant drop in the overall business happening every week.
All right, but we'll clear some mess at least
Certainly.
in the short run. Yes, sir.
And Amit, one of the implications that I think of these recommendations is that intraday trading volumes could go up, and as we know that that's also another form of speculative trading. Do you think that after FNO, SEBI comes after intraday trading?
No, actually, SEBI has already, limited the leverage which you can take on an intraday basis about 3 years ago. So in the intraday cash market, the leverage is maximum, I think, 6x of what you can take of the margin. So I think that is already capped, and I don't see a problem there. The volume in the intraday cash market can increase because a lot of people who would be speculating in the options markets, they might shift here, but that's a thing which we have to wait and see. That might take some 3 to 6 months to happen.
All right, and since we were talking about exchanges, we were also looking at the impact on both BSE and NSE. It is suggested there'll be higher impact on NSE as options account for about 60% of its revenues. For BSE, it's going to be about 40%. So there is an estimation here that NSE's earnings will take a beating to the point of 25 to 30%, while BSE about 15 to 18%, Suyash. But the stock was up today.
Interestingly, the stock was up, and you put out the numbers absolutely. The numbers are correct for financial year 26. Earnings impact for NSE could be about 25 to 30% because they have a higher share of the entire trading volumes compared to BSE. BSE could also take a hit of about 15 to 18%. But both, Amit, I'll come to you on this one. Help us understand, why was BSE stock up 6% today?
I think, almost 3-4 weeks ago, when there were media reports of these so many changes, 7-8 changes coming along, stock has been under pressure. And remember, for the past 3-4 months, both RBI and SEBI and even the finance ministry people have been talking about bringing in measures to control FNO speculative activities. So the stock has already been down 30-35%. So one can say, once the measures are out, these is sort of buy. You square off your positions when the fact is out. But I think the fact that they've allowed in the proposals only one expiry, that could actually benefit a lot to BSE. Because, in NSE, the two big index are Bank Nifty options and the Nifty options. And if they have to choose one of the options, they need to let go of, either Bank Nifty or Nifty. So ultimately, the BSE would help that. So, for example, if they let go of Bank Nifty, then the banking benchmark, which is BankX in BSE, that would see a rise in the volumes. So I think, if that proposal goes through, and I don't know whether it will, there will be pushback from NSE on that. But if it goes through, then that could be very beneficial for BSE. So I think that's why the stock was up. But again, this is at a proposal stage. Comments are welcome till 22nd August, and then SEBI is going to take the final call. So we'll see how it goes in the next 3 months.
And Rohit, I have a question for you. I mean, the entire purpose of these new recommendations that have been proposed by SEBI is to, stop retail investors from dabbling in derivatives market and protect our markets from a systemic failure. But do you think it could lead to something called a dabba trading, wherein, traders are still speculating on price action, but outside the purview of SEBI recognized stock exchanges?
So I heard this concern from several brokers today in the media saying that it will lead to dabba trading really picking up. It could because the intent to speculate cannot really be killed. It's like you always like the same thing which has happened in gold, right? Gold smuggling shot up because you put huge duties on gold for a persistent period of time without reversing them even when your currency crisis is behind. So it's the same thing that when you try to curb something, it overflows into something else. But the bigger unfortunate point is that we are still hearing about dabba trading. 25 years I've been hearing about that as a competition to brokers. I don't know why we've really not been able to clamp down on that. That is, I think, the bigger issue. But yeah, it can result in that spillover happening because speculators will want to go somewhere, and I think the dabbas will try to take advantage of that.
All right. And I also want to quickly understand, Rohit, from you, the impact perhaps on discount brokers like Zerodha, Paytm Money, Angel One. They are, of course, expected to face high impact from tightening in the F&O market and the recent changes in transactional tax as well. What is the impact that you're looking at as far as brokers is concerned?
So each of these measures, first of all, becomes a lot of administrative headache because, collection of margins, following up with clients, and, discount brokers often, they basically follow a what should we call it? They don't have RMs and all for, dealing with clients. They want everything to work seamlessly. So that does put a lot of pressure on reworking the technology. If we do things like, doing away with multiple securities in the weekly contracts, then that definitely hits their business because a lot of business is happening in the option space, and that is where you do those minimum or zero brokerage. So I think somewhere brokerages will show up because we've also done away with the amount of money they get from the exchanges, which was their main source of revenue. There's a potential that you move from zero to deep discount brokerages. So that's one change that could happen.
All right, potentially traders moving away to big discount brokerages. That is a change that is expected. But before I close the show, Rohit and Amit, coming to you, one of the things that our Madhabi Buch has constantly said is that we want more of household money, which is what they're concerned of, going towards perhaps mutual funds, IPOs, instead of going towards speculative market. Do you see that happening as a result of these measures?
So I think the intent is, the right. It is just not, equity markets. They want the money to be flowing back. The financial assets could be even as simple as FD. In fact, the recent taxation changes actually opens up a retail debt market also. So I think they want that, instead of speculating and losing all the money, the retail investors should actually invest in either institutionalized products like mutual funds or go back to the bank deposits like FDs, etc. Or in general, stay within the system and not lose the money because they have all the data. They know that how people are losing the money, how the small investors are punting with like 5,000, 10,000, 1 lakh rupees into the markets are actually losing it at a big amount, and then this has been happening for quite some time now. So I think the intention is right. How much it gets implemented, that I think we need to wait and watch.
Right. All right. There is a thrust for people's money to go back to institutionalized financial systems.
And banks too. I mean, they are struggling with deposits.
Absolutely.
The difference between
but
credit and deposits.
Speculators are going to speculate at the end of the day.
And where do they speculate now? Outside of Povio market, perhaps in dabba systems. But, Rohit, after all, it's a consultation paper. SEBI seeking feedback from industry. If you could give one recommendation to SEBI outside of these 7 that they have stated, what would that be?
Well, I wouldn't really have, minded that if they do away with weekly options altogether, if that's what they really intend, that you don't want retail investors to come in, why not just end it altogether? But if you're going to keep it, then definitely some measures to, take it away from madness to something which is a little more sensible is helpful.
All right. Rohit, Amit, thank you very much. Suyash, thank you very much, all of you, for taking time out for joining us on the show. We are, of course, talking about the crackdown of markets regulator on speculative trading, F&O trading, which is being a concern for the current dispensation, growing concern for a matter of last few months. And so 7 measures have now been put into place. Several measures, 7 in particular, have been put into place to ensure that there is a crackdown on F&O trading.